It's been one of the most exciting weeks for investors all year. Hong Kong stocks surged for a third week straight, with the 3 trillion market rally driven by China's stimulus injection efforts. Here to tell us more is Kenny Wen, the head of investment strategy at KGI Asia. Welcome, Kenny.
Hello.
Well, we saw markets in Hong Kong lift to a 20-month high. Where is this positive sentiment coming from?
I think there's two reasons. First of all, related to US. FOMC has cut the interest rate 50 basis points, which is higher than our expectation. And also, according to their latest forecast, this year GDP for US is talking about 2%. That is soft landing. That's why you can see the US stock performed so well. And other even more important factors will be central government during the past 2 weeks. They has announced a lot of several measures to boost up the economy. I think it helped the market sentiment and confidence. So that's why Hong Kong stock performed so well.
Yes, we have seen a massive stimulus coming out of Beijing. Is it going to be sustainable to continue to drive the Hong Kong stocks?
It is a very challenging question, but I think for short term it can, because we're still looking for even more physical measures will be announced after the national holiday. And then I think we are some kind of honeymoon period, because after some measure being announced, people will be patient to see for coming 1 to 2 months whether the real economy will be improved. So given the coming few weeks, they will be patient. So I think it will be good for the overall stock market.
Indeed, and I guess all eyes are turning to the next US Federal Reserve meeting on November 7. Many traders are expecting a quarter-point cut, with about a third expecting as much as a half. Yeah, and possibly. Well, what is your prediction?
Put it this way, we think for November and even December will be 25 basis points each. Because you can refer to the latest round of economic data in US. It's not so bad. And also now the inflation rate is still higher than 2%. So I think 25 basis points will be more appropriate. On the other hand, if you cut another round of 50 basis points, it may send a very wrong signal to the market that there's something not good in the economy. But anyway, for next year, we will be a little bit more aggressive, because we worry that for next year, Q1 or Q2, US economy will slow down significantly. Then in that time, FOMC may act more aggressive. But for coming until the end of this year, we are still looking for 50 basis points, which is matched with the dog chart. So a little bit maybe conservative compared with those traders.
Right. So most likely 25 basis points, a bit more stable, a bit more soft.
Exactly.
Bringing it back to Hong Kong, Hong Kong's commercial banks only passed half of the last rate cuts in September to borrowers. Come November, should they bring more of the rate cuts to consumers in order to possibly stimulate credit spending? And what do you think?
No, because frankly speaking, in September, they cut 25 basis points. I mean, the Hong Kong Commercial Bank is already out of our expectation. If you refer to the previous rate hike cycle in US, Hong Kong banks did not follow exactly the magnitude. So we originally expect they will on hold and only cutting rates at the end of this year. So in September, they are already doing much more than we expected. And as I mentioned, that we expect in November, FOMC only cut 25 basis points. So I think Hong Kong Commercial Bank will stay put this time. They may cut another round in the end of this year or next year.
And how will that impact the property market in Hong Kong and perhaps the stock market in Hong Kong?
For Hong Kong stock market, will be very positive, because given the current improved sentiment with a lowering borrowing cost, everyone will eager to borrow through margin financing and buy stock to enhance their returns. But I think do not overestimate the impact, because some margin financing is related to HIBOR, not the prime rate. So the investor already enjoying a lower rate for the past few months. And I think the most important is the market sentiment, not the borrowing rate level. And property market will be a little bit complicated. For short term, I think it will be improved. It will improve the transaction volume. But for long term, it still depends on the Hong Kong economy. And also, don't forget that in Hong Kong, they are talking about 30 or 40,000 unsold homes in Hong Kong. There's take time to digest those unsold inventory. So don't be too positive for the coming future unless we see some improvement in China or Hong Kong economy.
It's certainly going to be a busy end of year.
Yeah.
What is your prediction for the Seng index by the end of the year?
Okay. Originally, our target for second half of this year, 20,900, which is already passed through this level. We didn't change because everything happened so suddenly. We still keep it this target. And frankly speaking, we are approaching the end of this year. We may start to targeting 2025. But personally, given the more powerful stimulus measure from China and the recent transaction volume is talking about 400, 500 billion Hong Kong dollar every day. And I talked with some institutional investor, maybe hedge fund, they already increased the exposure in Hong Kong. But for long only fund, they still wait and see. So I think in terms of the liquidity and sentiment, we can have further way to go. Personally, I'm looking for 24 to 25,000 points for Hang Seng index this year.
Right, well, quite a positive outlook.
Yeah, but anyway, we need to keep track the development in the China economy. If no improvement in economy, then I think this rally will be short-lived.
Quite right. Well, thank you so much for your time, Kenny.
Thank you.
And to get more market insights into what's happening in China and around the world, head to our website at scmp.com.